Louise Bedford here from the Talking Trading podcast. This is how traders excel. I wanted to kick off with a story from my background. When I first became a full-time trader, I remember going to my accountant at the time, and he's a very tall, imposing man, and we were walking up some stairs, and I remember saying to him, I am going to trade full time. At that stage, I'd lost the use of my hands and arms, and it took 3 years for it to all recover. But unfortunately, he was on an upper stair. He looked down at me and he laughed. He didn't even try and smother the cackle. He laughed right in my face. And he said, you will never, ever be a full-time trader. Look at you. You can't even move your arms. I was taken aback. In that very moment, realized, my goodness, this is exactly what I'm going to do. That spark of anger, that snap point, he pushed me right into the abyss. And I just thought to myself, it took me a little while on that angry walk home, but I thought to myself, I wonder how much he is earning. As soon as I earn as much as he is earning as a full-time accountant when I'm trading full-time, then I'll drop him. But until then, I'll let him watch my ascent. My goodness. So sometimes anger can be a good thing. Now, I've got a wonderful guest lined up for you today. Tony Saliba is a bona fide market wizard. And just before I introduce Tony, I would love to hear your views about that little story about my accountant.
My God. Hi, Louise. Great to see you. I actually got goosebumps while you were telling the story, because those, I know you have, but those in your audience that have read Market Wizards, or at least my chapter, I recount the situation that is almost identical. A couple differences. One, I work for this gentleman, and two, I didn't get to rub it in his face or, come back later because your accountant stayed in your life or whatever. But I had a situation where I was living in Indianapolis, Indiana, which is a nice town, but a small town, and it was known for a great place to raise a family. And I was 23 years old, 22, almost 23. And it was pretty boring there during the Jimmy Carter malaise days of the stock market and the economy. And I said, who makes all the money in this industry? And they said, the guys on the floor. And I had grown up in Chicago and caddied for commodity brokers and traders. And I said, oh my God, I know what they're talking about. And so I got back in touch with some people in Chicago, and I got a job lined up to go back up to Chicago in the trading floor. So when I went in to tell my boss, and he was a big man. He was probably, 6'6", 6'7", and probably, 250, 280 pounds. And I was, 5'6", and, 150 pounds. And I said, I told him this. He goes, he just laughed at me in my face. He just basically, in an embarrassing way, belly laughed and said, you'll never make it. You're too small. And I'm like, what are you talking about? And he acted like he knew something about it. He had been up to the CBOE and seen the floor. In fact, that company that I worked for, City Securities, great people there, but my boss just couldn't control himself. They had bought a seat on the exchange back then. This was in 1978, and they were $10,000 a piece. So he knew a little bit about it. And he told me I was never going to make it, that it was too little. It was a big man's game, and that, he would be there with my job when I came back to him, tail between my legs. And like you said, anger is a motivator, and this is a human trait that is, I'm going to show him, whether you actually push it back in his face or not. And, there were times when I thought, oh my God, maybe he was right. But, needless to say, it pushed me enough to prove to him that he didn't know what he was talking about. And, I just can't believe he even did it to me. And then, Jack Schwager recorded that in Market Wizards. But there were other, trials and tribulations along the way. But that one was one. If I had a chance to, I think he's not with us any longer. But if I had a chance to sit down with him and point out the failures of his approach, I would have. But I just done
Isn't
running.
it good? We can use this for motivation, though. So, this show is for everybody who feels the need to stick it to somebody. So, I do feel that this is now where I fully need to introduce you, Tony, because you are a bona fide market wizard, famously the only options trader to feature in Jack's book. Last time I was speaking with Jack, we actually mentioned your name, so your ears were probably burning. You earned around about $9 million by the time you were 30. I love that. So you really just sprang out of the gates. You're well known for founding Liquid Point, a trading platform which sold for $250 million. So we're getting a sense that it's exponential with you. And more recently, you've founded Liquid Mercury, liquidmercury.com. It's a crypto trading platform designed for professional traders. Now, I know you're also the founding member in several key companies in the trading industry, Matrix Executions, and Efficient Capital Management. Today, I have cornered you to talk to you about how to transitioning from traditional markets to perhaps more alternative markets, such as crypto and digital asset markets. So let's kick off with looking at the trading universe. How important do you feel it to be in the right market at the right time?
Well, it's very important. There used to be a badge, a button that we would wear, that certain people would wear on their trading jackets when we were on the floor in the 80s, which said, "Don't mistake a bull market for brains." And mainly it was that this market is going somewhere, whether you figure it out or not. And if you get on board, you'll make money. Doesn't mean you're smart. And trickier markets make it more difficult, obviously. So being in the right market, to your point, is critical. And we also used to say it's all about price change. We want, if a market just is flat with no volatility, it's very difficult, no matter what your time frame is, unless you're an abject premium seller and all you did was pound premium all the time. In a sideways market, it's harder to make money. You need price change.
So just to define that term, when Tony's talking about pounding premium, he's talking about being an options writer, where you're collecting a small amount of money for a contingent liability that is unlimited. So I was an options writer way back when, and there was one particular trade where I could have potentially lost $700,000, of which I did not have at that stage, which actually made me realize risk management might be a good idea. Continue, Tony.
Well, so your question is how important is it to be in the right market? And it's kind of difficult when let's say you're a bond trader or you're trading fixed income and it's just sitting around and you're seeing the stock market go crazy, or you're a commodity trader and it's not doing much and you see currencies moving around. So having an understanding of different markets and which one you can actually access. It's hard to trade in fixed income, harder than at least in the US, than equities. And then there's digital assets, cryptocurrencies, if you will, that became very popular in the last 5 to 8 years. It's a 13-year-old market, but really was below most people's radars for the first few years. And to this day, less than 5% of investing public are familiar with how you can take advantage of this investable asset. Now, as you and I talked before, some of the same strategies you would use in equity trading or commodity trading will work in certain digital assets. Bitcoin being the most popular and the most liquid, but there are also a handful. The top 10 are still pretty liquid and trade millions of dollars of notional every day, tens of millions of dollars in some cases every day. So the ability to move into these other asset classes are important because they have potentially non-correlated price movements. In fact, just recently, week before last, Stanley Druckenmiller and Paul Tudor Jones, who's also in Market Wizards, the first one that I was in, were being interviewed, and they talked about digital assets, particularly Bitcoin, how they are the solid investment for today's youth, meaning they're the gold of millennials and Gen Zs, the Zoomers, right? And a bit of that is true. Some similarities and differences, at least with Bitcoin and most digital assets, they have a finite amount. You cannot say that about currencies. The US dollar is being printed all the time. You really can't say that about precious metal. Gold and silver is being mined all the time. But with digital assets, there's a finite amount. Thus, they are very inflation proof. Okay. But there are pitfalls. Up until recently, they were difficult to access. They were difficult to protect yourself. You have an account, which is called a wallet, whether it's online with a exchange like a Coinbase or a Gemini, or if it's cold wallet that you maintain yourself. There's some passwords and keys that you have to remember, but it's not that hard once you get used to it. And the trading tools have advanced tremendously over the last few years. Traditional finance has moved into this space to the degree that a lot of you will find tools, trading tools, that you're very used to in trading options or shares or futures.
So really what you're saying is that we need to consider it as just another market, and we need to look at the trading universe that we are drawing from. I often find with people who have done my mentor program, if they can prepare themselves for 3 markets as a minimum, so that they understand something like CFDs, they understand equities, they understand commodities, and that way when a trend is coming into play in one of those markets, they are at the ready and they can strike while the iron is hot. So often I see people struggle because they are not ready. They haven't attuned their skills so that they're ready to strike like a sniper. I do think what you're saying here about digital assets being a very similar trading tool, if we consider it in that light, then it can be looked at as a possible part of our universe. That's what you're saying here, isn't it?
Absolutely. Well, we all have different time frames and different styles, right? So for day trading, you have one set of characteristics that you would be looking for in the asset class you're trading. If you're midterm investing, or if you're hedging a different portfolio, or if you're just looking for some preservation of capital, all of these things, weigh differently upon the asset class. For instance, a year ago, when almost to the day, when Sam Bankman-Fried announced that he'd been scamming everybody and Bitcoin lost half of its value and went down to under $15,000 a coin, people were screaming this was, unsafe, it's volatile, whatever. It's more than doubled in price since then. It made a pretty decent recovery. A lot of that drop was people that had to liquidate because they had assets tied up with this fraudulent entity, and there was a credit crunch, and there was a lot of movement of assets that were panic driven, and now things have stabilized and basically back on the march again. But that asset, one Bitcoin, let's say, at $15,000 or $16,000, since there's a finite amount of Bitcoins, some people say that someday that will be worth $1 million in 5 or 10 years. I don't know. The fact of the matter, though, is it is an offset. Just holding it is an offset to US dollars or other, as we call them, fiat currencies. So having a little bit in your portfolio, whether you're trading around it or not, is a strategy. And options are coming to listed markets on these products as we speak. Options that trade on the current exchanges have outstripped options volume growth on the other products hand over fist the last few years. This is an asset class that is really attuned and designed really for options. So if you have these strategies that you like to use in your normal trading, you would find that they will work in the digital assets.
Do you still trade options then over traditional markets?
I don't trade very much personally. I'm running this technology company, although I do have a portfolio. I look at it in the corner of my eye. Up until 2023, I was trading some oil strategies. I was using options to short, S&Ps against those oil strategies. But really, this year, I've been really focused on our solution, which, if I could say, it isn't just for trading digital assets that are crypto currencies or tokens or coins. It's set up for use in carbon credit markets or in sovereign bonds, or we could even see a solution for local small businesses that have branch offices that need to move digitized information around and manage it. So really, more and more, Louise, is being digitized. People are fractionally owning buildings now by digitizing a skyscraper or a strip mall, and eventually U.S. Equities will all be digitized. It's just a cleaner, easier way to do accounting, and these smart contracts are brilliant. You can attach any valuation so that a person's behavior gives them credit, and so there's a lot of wonderful things that come out of digitization. And for me to trade, I miss all the innovation that me and my team are uncovering all the time in our business.
Yeah, and this can be the creative part of trading. Often we think of traders as being very systematic, which we should be. We should be dictated to by our discipline. We should be sound followers of our trading plan. But there are creative outlets in this, and one of them is where we put our money and what percentages go in each bucket. So for me personally, and I'd love your thoughts on this because I haven't actually discussed this in public very much, but I've got 3 buckets of money. One is longer term, and that even includes property, because I'm talking about being a broad overall investor, which is also the other asset classes. It's investing in business, in property, and in the financial markets, which includes spaces that are option oriented, that are equity oriented, that are commodity oriented. So financial markets are the broad stock market concept. So I've got my longer term bucket that has like a lot of the money in it, and then the medium term bucket has a medium term view, because that's where I found traditionally I've made most of my money from that medium term time frame. And then I have my 10 to 15% of my money bucket, which is for things that I'm experimenting with. Maybe it's a new strategy, maybe it's a new time frame, maybe it's a new market, maybe it's something that is unregulated. Now, I understand the entire crypto market is an unregulated market, and I want your thoughts firstly about separating risk based on asset groups, and I would also love your thoughts about the regulation around the crypto market.
Well, as you were listing your buckets, I'm thinking about mine, and I'm glad you said investing in business too, because I would say that I'm a fair bit older than you, and I do have my buckets, and I haven't thought of them as succinctly as you just listed, but I have my land or property, real estate, obviously, multiple homes, but the business part, which is where I can control what's going on by actually operating it, is where I have the most. Okay, and so I have insurance products. I have basic share portfolios that third party manages for me. Then I have some other companies that are run by friends of mine that have a small amount placed around there to see if they do well. And then I do have some trading capital at the ready to take on a new idea, or as I said, last year, in 21, I traded the meme stocks. We were all, locked up, COVID. So there was a lot of trading going on at that point. But this year, not really slinging it, as I would say, and I like to look at options matrices, and I can see risk reward setting up, with different vertical spreads. And I'm a big fan of scaling into and out of positions, because you don't have to be spot on your pulling the trigger. You can scale into it and then be generally right, and then scale out of it when your strategy starts to pay off. So I have probably 70 to 80% of my wealth in my companies that I manage. Okay, and that is important to me because they generate income. I'm in charge of the risk management, so if something goes wrong, I'm there to stop it, or if something goes right, I'm there to help maximize that. But for those who are just starting out or don't have that kind of diversification that you or I have talked about, I think smaller amounts are fine. I think the way to play new companies cheaply are alternative tokens in digital assets, because they're so inexpensive on a unit basis. For instance, our token is less than a penny. Okay, so you can get leverage by putting a few $1,000s to work and buy tens of thousands of units, and it's a direct play on the growth of the digital industry, because we're a layer two. We call them a layer two provider. We have software that are applications that go on top of the blockchain. So people can play that business side that way, and they don't, they can trade in and out of them, or they can just say, I'm going to wait a year or two till these things are 5 or 10x, that kind of thing.
This is fantastic, because I do think we have got a lot of listeners across a variety of different levels in terms of where they're starting compared to the very accomplished, and also the assets that they have behind them. I'm even teaching my youngest daughter at the moment about this same concept, where property is difficult for a kid to get involved with. However, she can loan her parents some money for our next property deal. Things like digital assets are something that she can get directly involved with if you're saying that it costs that much. So that is a fantastic strategy. I'm loving that. And
Your listeners,
everybody,
sorry, go ahead. Sorry.
yeah, everybody listening as well, Tony and I are talking as friends comparing quite high level strategies. So just remember, even though I have an AFSL, Australian Financial Securities license, this doesn't mean it's actually specific advice. This is general advice and education, and we're letting you eavesdrop into our conversation. Go ahead, Tony.
No, I was just going to say it's as easy as going online, and one of the most popular vehicles is called Metamask, META, Metamask. And it is a piece of software that is a wallet for digital assets. And it's really easy to use, and it connects to various different places where you might want to trade. And you have DeFi, which is a deconstructed marketplace. It's decentralized, if you will. And there's some popular ones like Uniswap and SushiSwap that you can find almost any coin on it. And it's as easy as putting in, $1,000 or $100. I mean, people can get started with literally, small, tiny amounts of money, which you can't do in the regulated markets because brokers won't open accounts for $500. They don't want to hassle all that. So to do that and then go do some research and see what companies have tokens out there. Now, Bitcoin trades at $34,000, but it goes out 8 decimal places, so you can buy $50 worth, and it'll track with the token because it's just a fraction of it. So it's really democratized, to say the least. And as I mentioned, more of traditional finance is moving in to make it easier to understand, safer. Schwab and Fidelity, two of the big brokerage houses in the world, but in the United States, have formed a partnership, even though they're abject competitors, to trade digital currencies. And they're launching here very soon because their customers are demanding it. So it's happening. It reminds me of the beginning of options trading, where people are like, oh, we're fine with stocks and bonds. Why do we need that? And options are the best product ever designed, and options on digital assets will be even better.
You're speaking my language with the options market, don't you, Tony? Because my very first book, The Secret of Writing Options, that is how I managed to transition from my job into being a full-time trader, because that premium that I was collecting was like a replacement for my income. I did miss my pay packet. Let's just be 100% clear. But that options premium definitely became that replacement. So that regulation, can we get back to that? Because I'd love your perspective on where we are now and where are we moving to with the digital assets market and regulation.
Well, so every jurisdiction is different, meaning, countries. And I believe the Australian jurisdiction is much more advanced, far more advanced than the U.S. jurisdiction, where the U.S. government has tried everything from trying to talk it down, say that it's risky and unsafe, to regulating by enforcement, just dropping yellow flags everywhere saying, oh, you're crossing the line, to now trying to compete with its own digital dollar, the FedNow program, which is a CBDC, digital dollar. So the U.S. is a swirling bowl of ideas that hasn't really set itself up very well yet. But I think it's getting there. Whereas Europe, they have MICA, which is a set of rules that has been pretty well thought and embraced. Look, nothing's perfect, but we were talking earlier today, you and I, about Aussie rules. And, you can pick any game. If you don't have markers on the ground, you don't know when you're in bounds or out of bounds. They may not be perfect. They may not be right. They can be adjusted, but at least put something down. So people were missing capital formation in this country around this industry, and it's going offshore. But if you go to island nations, Europe, Singapore, big time, Hong Kong, and from what I understand, to a great degree in Australia, the rule set is much more formulated, and agents have rules. The biggest thing is that you don't tell the investing public something that's a lie or incorrect or fraudulent. You need to protect the public from information that is untrue, okay? Because they're going to place some money on that. And so rather than setting these rules up in our country, there are no rules. And they do have rules big time in those other jurisdictions, like all of Europe and Singapore. And I do believe in Australia, they're much more defined. So it's coming. And why does this matter? For security, for the safety of the transmission of your money back and forth. The trading venue should be private, secure, anonymous. And I think you'll find an experience today that is quite similar to what you're used to trading in the shares market or in the options market, but also the movement is non-correlated, asynchronous to other assets. So you find matches that I have a portfolio of stocks I mentioned earlier, and a friend of mine is a PhD. He studied under Harry Markowitz, modern portfolio theory, and he showed me how certain cryptocurrencies, certain digital assets will enhance the ratios, the risk ratios on your stock portfolios by adding a small amount to them. So I think you can bridge both worlds right now.
I think what you're talking about as well is being open-minded, that so often, me included, we get stuck in this rut where we think, okay, I'm good at this, this, and this, and nothing else, nothing else, nothing else. I'll just stick with this. The difficulty with that fixed mindset is that it stops us from looking further afield. It stops us from potentially keeping up with a trend that might be happening under our very nose. I think a lot of people have been scared about crypto because of the hype and the scams, because there have been so many. If you look at the history of the stock market, those bucket shops way back when, they didn't sound all that regulated, did they? Because they were not. So perhaps what we're doing here is, and correct me if I'm wrong, I'm gleaning it from what you're saying, are we looking at a product life cycle where the introduction phase is a little bit like the Wild West, and then in that growth phase, as more and more people get involved, those people have got demands, and those demands must be satisfied for maturity to occur. Is that what we're looking at?
Yes, absolutely. What we have today is much more. Well, everybody should watch Wolf of Wall Street, right? So that talked about those bucket shops back in the day, and it was an amalgamation of different characters and different real things in true life, supposedly, that happened. And we had that. We had it in shares. We had it in futures here. We had it. There was a over-the-counter market. For options before we listed them, that was happening. So the whole thing is really about maturing. And you have a lot of that already in digital assets. The difference is you can get started on your own, like I said, with a wallet and still be a player without having to go to a broker or to open an account somewhere. I mean, eventually you might want to be bigger, but in the beginning, I saw, I met people who had millions of dollars on a little key fob that they could go around the world with, and you can't do that with your, the U.S. only lets you travel with 10,000 of your own dollars. How crazy is that? So it's liberating. It's it's a currency for the internet, basically, in the internet generation.
And what are some of the difficulties that you see with people transitioning from one market to another? I'm sure there are some growing pains, some teething pains as people embrace new opportunities. I'd love to hear your views.
Well, the growing pains. Well, so getting familiar with these rule sets, they're a little bit askew to what we're used to. We're used to having it's a lot like 20 years ago or 25 years ago before there was online trading. You had to call up a broker and things like that. Now everybody's fine using their phone or going to a website, opening an account, and so on and so forth. So there's a little bit of different characteristics to get started. There's different places to get data. But once you get past that, it's quite similar. Now, depending on where you currently trade today, even some of those bigger houses like Webull or Robinhood, or as I mentioned, Schwab and Fidelity, which are now offering like Bitcoin only, I think, you'll have some of your trading tools. But if you're doing it on your own, there's not a lot of trading tools that I don't know where I could recommend. Like TradingView has cryptocurrency in there, and then you can get your candlesticks and things like that. But
did you just mention candlesticks? Because I love them.
Yes. Well, it is a great tool, and you can get those on a few different sites for crypto, for digital assets. And we talked a little bit before about the stigmatism of the word, the C word, the crypto word. It's kind of a nickname. It's definitely kind of a bad boy's name, but the really digitized securities that are on a distributed ledger technology blockchain, it's just open accounting, and it happens pretty much lightning fast, and it's very logical and sensible and auditable. It makes a lot of sense, and I think that what we do isn't only for the currencies, the trading tokens that we've been talking about. Our technology can be used for real estate, or how about this, intellectual properties, or how about this, artwork. We have a company that uses our technology that does an NFT for every piece of art in a museum. And then you, as a donor, you're a patron of the arts, you donate to this museum all the time, you're happy to do that, makes you feel good. They need it, they need you, and then you get a tax deduction. But what this does, you also get a little representation of your favorite piece of art from that museum to go along with your donation. And we provide a marketplace so that if you want to sell it or trade it for somebody else's piece of art, it's an active and open marketplace for those NFTs. So you can't do this with paper. You can't do this with old-fashioned accounting, but you can do it with digital assets. And that's the technology we built so that it can be ubiquitous.
And what about the future? What do you see as the future trends that are emerging?
Well, I see the convergence of traditional financial trading and digital asset trading, because the same risk centers, the same investing centers, the same desire to um, um, modify, address, shape their risk reward profile will meet where, if you're an active trader of large, let's say you have a customer base and you're trading for them, you're not going to sit in front of a machine and click all day. You'll probably be on the phone with a broker who will do these things for you so that you can do your analysis or babysit some clients or whatever. So the bigger, lumpier business in options and in crypto go through an agent, and that agent uses the technology. That's going to be the same agent. We're seeing it happen today. I see widespread adoption. It isn't all straight up. You have hiccups like last year, besides the fraudster was a fraud, called it early on, guy just was scamming everyone. But before that, we had problems with over leveraging, with Three Arrows collapsing and Terra Luna and Voyager. These were because the securities lending, if you will, got heated up and over leveraged, and it became kind of a house of cards. And if one couldn't meet its obligation, it had a daisy chain effect with a number of entities. And for better or for worse, the structure that the SEC and FINRA have set up in the US and the various entities in the other jurisdictions in traditional markets doesn't totally prevent, but helps prevent against that with capital requirements and strict watchdog sort of approaches to that. And that's still kind of developing on the crypto side.
I'm liking what you're saying. I'm going to aim to give a big summary, and then I'm going to ask you for your thoughts because I'm going to miss a lot. Okay, I'm warning you, heads up. All right, so if you are looking to look further afield, expand out your already burgeoning trading skills, because you know how to enter, how to exit, and how to position size, you know how to work to a trading plan, and maybe you already understand one or two, maybe three other markets. There is the possibility to transition to other markets, such as digital assets. So the way to do it is firstly to educate yourself. Educate yourself so that you know the terms, that it can be tip of the tongue for the jargon that is required, that you start to feel comfortable around the trends that you're seeing, and use those same skills that you've developed as a trader in a brand new market. Start with a small position size, with a very limited percentage of your capital, preferably separated into a high risk bucket, the way that I do, and it sounds like the way Tony does as well. When you're starting a new system, start with a very, very small position size to get your head around it. Make sure you understand the impact of this being an unregulated market, but there are pros and there are cons for this as well. So bring everything you know as a trader, transition into a new market in a very small way before you scale up. Tony, your thoughts?
Wow, that's great. I have a hard time adding much to that. I would say for those who are trading today and busy and are like, I can't be bothered, to me, what I did is I nibbled and just, because you could literally spend a few $100s or a few $1,000s, depending on what your clip size is, and just have something to watch while you're doing your other trading. And you know how your rhythms, you start to say, okay, I'm seeing, let's pick Solana or Ethereum or Bitcoin, something, one of the top 5 or 10, or a little altcoin, and just say, okay, because there are plenty of applications where you can see the price history, and just say, I'm going to buy a little bit here and keep watching out the corner of my eye while I'm doing my normal trading. And then eventually you might start trading that more actively. And that's that's a good way to get your toe in the water if you're not already doing it.
I'm liking it, and it is also akin to your thought about scaling in to a position. You don't have to dump everything in the first position. It is very
Right.
possible to dip your toe in and then to see whether that trend unfolds and then to add more money to it. I'm very much one for pyramiding. I very much believe that that trade has to prove itself before it deserves more of your money. Now, for those who are fairly new to this game, perhaps you could tell us a little bit more about your website and what we can find at liquidmercury.com.
Sure. Well, if you go to liquidmercury.com, we have our tokenomics for our token, the Merc, MERC, which is a direct call on one of two things. If you're institutional, it's a discount on our products. If you're an individual, we have a loyalty program. So unlike a lot of other altcoins, there's a real business there with real revenues, and that token is a call on those, and it explains all that. It tells everybody what we do. It has links to podcasts that I do, such as yours, and other resources. We're very active in teaching people about options. We still believe in that totally. And we curate third-party trading tools and applications and give our opinions on those and say, this is done right. This one needs a little work, in our opinion. So those are all things that you can get when you go to our website, liquidmercury.com.
And is that the best way for people to stay in touch with you?
Yes, it is. Unless you become a member of our loyalty program, then we have a members portal, and I will actually answer everybody's questions personally. And then what we're going to start in the first quarter is a live session where people can ask questions, throw stones, basically hear about the latest trends and things that we're doing, because we're all over the place. We're mostly all digital, but we have people traveling all over in different jurisdictions to see what's popular in other markets, and we're going to talk about it.
That's magic. Tony Saliba, thank you so much for coming on to Talking Trading. I just have loved your story, and I love how relatable you are. And I really do feel like I've learned so much from this interview. This is not an area that I have delved into in a big way. So just knowing that you're in my corner actually really means so much. Thanks so much, Tony.
Well, thank you very much, Louise. You have a great one, and best of trading to all your listeners.